Happy New Year and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, January 2nd, 2020. Wow, 2020 is here. 2019 is gone. We're in a new decade. I actually read something pretty interesting. Didn't realize it, but apparently the decade doesn't start until the end of 2020, technically. I don't think anybody views it that way, but I think the original decades actually started after the end. It would be the end of 2020, not the beginning. But anyhow, that's just one useless fact. We got a lot to go over today. It is the start of a new year. I do want to wish everybody Happy New Year. Hope you had a good time through the holidays, able to spend some time with family and friends. You were safe, and now back and ready to go. We're going to start off the new year with a quick recap of what we saw at the end of last year. Of course, that was just on Tuesday. Today, I wanted to go over a little bit about the U.S. dollar and just the impact that it could have in 2020. I think everyone needs to be aware of it because the direction of the dollar does have a direct impact on some areas of the market. So I thought that would be certainly a useful topic today. Then we'll get into some of the upgrades and downgrades. No earnings, by the way. Very, very light in terms of earnings until another week to 10 days or so. Then we'll go into sector analysis. I wanted to point out just a couple of things you may not know. If you just simply look at the sector ETFs and just trade them, you really need to know what's in them. And we're going to talk a little bit about that later in the show. And then we'll wrap up with 3 you must see. Continuing that tradition from 2019, get a lot of positive feedback from you on that final segment. So those are 3 charts, I think, as we head into 2020 that you're going to want to take a look at. And these are all from a longer term perspective. I know my trading approach and style and strategy really focuses on the short term, but I think you might appreciate these 3 charts from a longer term perspective and how maybe a potential breakout. Maybe they already have broken out. Don't want to give away too much. But these are 3 that I think could be very interesting charts in 2020. Okay, before we get going, I want to mention just 2 days away. I know it seemed like it was a month away. Now all of a sudden it's 2 days away. Saturday, January 4th, Market Vision 2020. Got a lot of my fellow friends, colleagues here at StockCharts joining me over at earningsbeats.com. We've got an all-day online conference talking about 2020 and what everyone sees as we bring in the new year. John Murphy will be our keynote speaker. And you can head over to earningsbeats.com and register. Again, we're just 2 days away. Make sure you save your seat for that. I'm going to just show you very quickly. Actually, I can't. You're going to have to change something there. Zach, I can't share.
Done.
Okay, there we go. Happy New Year, by the way.
Happy New Year, everyone.
Yeah, awesome. I think we've got a lot of good stuff in store for 2020. I'm looking forward to it. And I know here at StockCharts TV, there's going to be a lot of positive changes throughout the year as we move forward. So really looking forward to working with you, Zach.
You too, Tom. It's been a pleasure over the last couple of years.
Yes, it has. And it continues to be a pleasure. All right, let's move on here. Market Vision 2020. There it is. So if you go to earningsbeats.com, and up at the top of the screen, there'll be some links, and one is Market Vision 2020. Click on that. It'll bring you right to this page, give you the pricing. You've got a register button here. We talk about the speakers, who's going to be there. It's a who's who list. Got the agenda, how it's going to break down on Saturday. John Murphy will be leading as the keynote address at 9 a.m. I will be wrapping things up at 5 p.m. It's going to be a great day, so hopefully everyone can make it out there. But go to earningsbeats.com, click on Market Vision 2020, and check it out. All right, let's move on to the market update. Let's get this daily market recap going here. It was the last day of 2019. We did have a positive day after opening lower. We pulled back a little bit at the end of last week, but I would say from a seasonal perspective, December came in just about like it usually comes in, which is bullish. First couple of days of December, we tend to do pretty well. We normally go through a little bit of a lag into the middle part of December, and then we rally into the year end. And that was pretty much the formula here, as you can see, with the exception maybe of that early drop at the beginning of December. That pretty much played out. So you can see all the major indices finished higher on Tuesday to close out the year. 10-year Treasury yield, you can see down a little bit today, down about 4 basis points from 1.92%. Materials, here are the groups that led on Tuesday. We had materials, the big leader, real estate also bouncing a little bit. It's come back up from the recent lows. I don't expect leadership in 2020 from real estate, but I do expect wide participation. I think the market goes higher. I think that all of the sectors will move up, but there will certainly be leaders. And we'll talk about some of that later in the show and definitely be talking about that at Market Vision 2020. Energy bounced back after gapping down. You can see earlier this week, we did have some weakness, but energy bounced back on Tuesday. And then utilities trying to make a breakout, still trailing on a relative basis to the S&P 500, but on an absolute basis trying to make a breakout. Renewable energy, I remember talking about this recently. As it moved down, it kept struggling between this 100 and 110 area. Wanted to see that breakout above 110. We've gotten it, got up to almost 120, tested that 20-day moving average, and now trying to move higher again. Really strong day on Tuesday. Renewable energy up 2.5%. Economic reports out today. We did have initial jobless claims out earlier, and it came in as expected, 222,000 jobs. That's exactly what the initial jobless claims was projected to do, right at 222,000. Later this morning, 9:45 a.m. Eastern Standard Time, we'll get the December PMI manufacturing report out. The estimate is 52.5. Last month in November, we had 52.6. So the market kind of just expecting things to kind of roll along as they have been, at least in terms of the December PMI manufacturing. Looking at this 10-year Treasury yield, this is a monthly chart. This goes back the last 15 years, so you can see overall downtrend. But I wanted to point out that we do have a triple bottom in play. So I believe that we're going to see the 10-year Treasury yield rise in 2020. I think we are just starting to move higher, very similar to what we did back here in the middle of 2016, started to rise and then took off. Same thing as 2012, started to rise, pulled back, then took off. I think we're going to see a similar situation here. I think we're sideways consolidating. I think 2020, we could have a run back up close to 3.25%. I would not be shocked. I think economic activity will pick up, and I think money will rotate out of treasuries and into equities. So 10-year Treasury yield is certainly something that I think we should keep an eye on. Now, the impact, though, is the dollar. So let's move on. Let's talk a little bit here about the dollar in 2020 and what this could mean. So I think the 10-year Treasury yield moves up, but the dollar is more dependent on how the Treasury yields here in the U.S. are doing versus Treasury yields in other parts of the world. I believe the most important one to compare against is Germany. I just feel like the correlation between Germany's stock market and bond market versus the U.S. is about as reliable as any other foreign country. And so this is just something I prefer. If you want to look elsewhere at other countries, that's fine. But I'm going to go through and just highlight some of the things that I find interesting when we compare the U.S. to Germany. So you've got the 10-year Treasury yield of the U.S. minus Germany's 10-year Treasury yield. So it's just the difference in the yields, not that one's going up or the other. This is simply the difference between the two. So when we've got a number that's rising, it means that the U.S. 10-year Treasury yield is rising faster than Germany. And when we're coming down, it means that Germany is rising faster. The U.S. is not keeping pace. Now, the interesting part of this is if you follow this chart and just look at the direction of the relative performance of the yields in these two countries, you get a pretty good idea of what the dollar is going to do. And if you think about it, the yield should be based, it should be rising based on economic activity or expectations in both countries. And so if the U.S. Treasury yield's rising faster than Germany's, you would think that our economy is stronger, or at least expected to be stronger. And if that's the case, the dollar should rise. If our economy is stronger than Germany's, then our dollar, at least versus their currency, should be moving up. And so I think what this chart does is it points this out. So over the last 10 years, actually this goes back 11 years, you can see that the Treasury yield, when it's rising, we tend to see the dollar index rising. So here we're moving up, dollar index is moving up. Here we're moving up, dollar index continues to move up. Now the red shaded areas are when we see an inverse relationship. So the dollar here was moving up, or excuse me, the yield in the US versus Germany was moving up, but the dollar went down. Same thing back in 2009. We saw US Treasury yields moving up faster than Germany's, but the dollar was going down. Again, 2017 into 2018, we saw the yields moving up in the US faster, but the dollar was going down. In each of these situations, you can see this inverse correlation showing up here at the bottom. I've circled that. For the most part, this correlation's positive, meaning that the dollar index moves in the direction of these two Treasury yields paired versus one another. So I think this is a pretty meaningful chart in that if you see what's going on between the Treasury yields in US and Germany, you can get a pretty good sense of what's going to happen to the US dollar. Well, take a look at what's been going on for about the last year and a half, or maybe year and a quarter. You can see that the US Treasury yields have been dropping relative to Germany. So the German yields have been moving up faster or dropping not as fast. They've been moving, if you take the difference, they're actually moving higher. So when you look at this, you say, okay, well, this has been moving down, but for about a year, the dollar kept stubbornly moving higher. And we had another one of these inverse correlations, but this is the first one in the last 11 years where we have seen the yields moving down in the US versus Germany and the dollar moving up. It's usually been the other way around. So if we're going to come back into this positive correlation, one of two things needs to happen. Either the 10-year Treasury yield here in the US needs to turn back up versus Germany, or the dollar is likely to weaken. I think it's going to be the latter. I think in the short term, we're going to see the dollar weaken. I think we could go down as low as 92.50 to 93 on the dollar index. And I think that in turn, when you look back and you see what happens when the dollar is moving up, what happens to materials versus the S&P 500? They move down. Anytime the dollar is rising, that's a headwind, has a negative impact on commodity prices and many materials and material stocks. So you can see the relative strength of materials. While the dollar index is going up, materials go down. So if the dollar comes down, one thing we might look for is the material group to outperform. Now, I don't think they're going to take off, but I think they could in the first 3 to 6 months of 2020. I wouldn't be surprised to see a bounce here and materials outperform the S&P 500. One area that should benefit from the dollar falling would be gold. There should be a direct benefit. You can see gold has not been a great place. I know a lot of folks getting excited because gold's been moving up, but guess what? Gold still really isn't moving up much faster than the S&P 500. So if you're trying to outperform the S&P, getting into gold hasn't been a great answer. That could change, again, first 3 to 6 months of 2020. I wouldn't be surprised if gold makes a run, especially if I do see this dollar continue to move down. I think the overall uptrend in the dollar remains intact, so don't misinterpret what I'm saying. But I do think that in the short term, again, maybe 3 to 6 months, wouldn't be surprised to see the dollar continue to struggle, and that could help both materials and more specifically gold. Let's look at the German DAX here for a minute, because the DAX has been moving up, but it hasn't broken out. The S&P has broken out. The DAX hasn't. And one of the reasons that, or one of the ways that you can trade and benefit from what's going on in Germany is by simply trading the EWG, which is the ETF that tracks the German stock market. The problem is the EWG is impacted by the dollar. So as the DAX has been moving up, look at the EWG relative to the DAX. It's been going down. Why? Because the dollar's been going up. The EWG is impacted by the US dollar. So when the dollar rises, that actually hurts the EWG. When the dollar falls, as it's starting to here, then we start to see a little relative outperformance in the EWG versus the DAX. So if the dollar falls and we get a breakout in the DAX, the EWG is something that could benefit from a falling dollar, maybe in the first half of the year. Maybe it's all year. I don't know. We'll have to continue to evaluate that. Next chart here is the EWG versus the DAX, and as you can see, it has been going down. This is the correlation down here at the bottom, EWG versus the DAX, and then compare that to the US dollar. And you can see correlation stays almost always down at -1 or very close to it, meaning that it moves inversely. So if the dollar goes up, EWG underperforms. If the dollar goes down, EWG outperforms. Keep that in mind. Just looking at the German DAX, just the yield, the 10-year Treasury yield here in Germany, not the DAX, sorry, but the Treasury yield here, you can see over the last 4 months, it's been moving up. And I talk about this in the US a lot. When money is rotating out of Treasuries, normally you're going to see that money rotate into equities. When the Treasury yield's moving up, it means Treasuries are being sold in Germany. So those proceeds are being used to move into the DAX. And that's one of the reasons why we're seeing the DAX moving up and why I think we're going to get that breakout in the DAX. I think we're going to get a breakout internationally in most markets in 2020 if we haven't already. Let's see, the S&P versus the DAX. I just wanted to point this out, that as the dollar goes up, it tells us our economy is stronger. So you would think the S&P would outperform the DAX. It's not really that clear. A lot of sideways movement, even though the Treasury yield was going up, the dollar was going up. But you can see in 2018, 2019, that relationship did kind of work out. But now that we're starting to see movement down and expecting the dollar to fall, maybe the DAX outperforms. Maybe this starts to roll over. The S&P may underperform as we go forward. Okay, I'm going to move on to upgrades and downgrades. And I'm going to start on an upgrade here, BlackRock. So BlackRock was upgraded, and I'm looking at the chart. And when I look at these upgrades and downgrades, I like to look and see how these stocks are performing on an absolute basis, which is nice here. BlackRock's broken out above this double top. Good volume on the breakout. I think it's moving higher. On a relative basis, not bad. It's not the leader in the asset managers group, but it's not a bad performer. Starting to turn back up. It's about a 2.5 month relative high. I'm okay with this upgrade. I kind of agree with it. Next up, GIII, which is G3 Apparel Group. It has been moving up. I really like this red hollow candle here. Big volume. It gaps down, but then comes right back up and breaks out. That tells me probably the selling has been overdone to the downside. That last gap was an opportunity to accumulate. We broke right out, nice volume trends. And when you look at a relative basis, we are now at about a 7-month relative high versus the clothing and accessories group. So this is a stock that I agree with the upgrade. Let's do one more here. Let's go to WRK, which is WestRock. Nice move to the upside, very strong volume trend. So we got a breakout on good volume. And on a relative basis, we're now at about 11-month relative high. So this is a stock that I certainly would agree with an upgrade. To the downside, downgrades, let's check out Abbott Labs, ABT. Abbott Labs downgraded. Look at this uptrend, nice little cup, maybe a pullback, little handle here. Doesn't look too bad, except look the pharmas. The pharmas have been on fire. So on a relative basis, Abbott has been downtrending for about 6 months. So, you know, you look at the absolute chart and it looks pretty nice, but on a relative basis, doesn't look so nice. I think I'd need to see the breakout. I'm okay with this downgrade for now. Let's get the breakout and then maybe we'll reevaluate. Next up, downgrade Core Labs. This one now, look at this chart. I think it's pretty easy to see this has been an underperformer. It's been downtrending. It gaps down today, or excuse me, gap down on Tuesday, big volume. Not surprising at all. Look at the relative strength on the stock. Just moving to a new 52-week low. Yeah, I would certainly have to downgrade this stock as well. If you're in it, I would not want to lose this low. For a stock that's downtrending, relative underperformer, big volume on the selling, all of that combined, I don't want to lose support. All right, let's look at one more here on the downgrade side. DCO, Dukeman. I have no idea how to pronounce that. I'm probably butchering it. But anyway, you can see we are trying to make a breakout above $52. A couple of nice gap ups here on the chart, a few of them actually. Got one in March, got one in May, got another one here in August, and one in October. This one looks like it wants to make the breakout. Not a lot of volume here, so that would probably bother me. But on a relative basis, this stock is at about a 8-month high. relative high to the aerospace group, and it's been going up. It's got nice volume, and it's being downgraded. I actually think downgrade could be an opportunity here. So again, if the volume's too light, I wouldn't trade it personally because of that. But the chart tells me something different than what the analyst is telling me. All right, let's move on. We are going to jump into sector analysis. And what I want to do here is I want to show you a couple of ways of looking at strength in a sector first off. So I have a relative strength chart list where I have all the sectors. So I can look very quickly to see on a relative basis which sectors are performing well versus the S&P 500. I think you can tell that 2019 belonged to technology. Huge move up. We had a little bit of weakness mid-April into mid-May. Other than that, for the most part, we were outperforming almost all year long, which is good. It's an aggressive area of the market. That's what we want to see. When everybody's talking doom and gloom and about the recession, 20 of the 0 recessions in 2019 were called by analysts. And when you're hearing those recession calls, you need to think for yourself. You got to look at these charts. Technology, if we're heading into a recession, technology, those high growth technology stocks are not going to perform well. The market knows they're not going to perform well. So if we're going into a recession, you would begin to see some deterioration in technology. If you did start to see breakdowns below the 20 and especially below the 50, and the weekly relative PPO were to drop below the 0 line, those are warning signs. We had none of that in 2019. And I could go through all of these, but I want to really just focus on not just looking at the relative strength, but also looking at the absolute strength. So the XLK making a breakout, higher highs, higher lows throughout the year. Nothing bad here at all. Now, there is one other thing to consider here, and that is that the XLK, you think, oh, I own this huge basket of technology stocks. Well, you don't. If you're in the XLK, more than 38% of your investment is in Microsoft and Apple. Those two stocks each represent 19% of the ETF. Apple, actually Microsoft, a little bit more than Apple. So if you're looking at the XLK and you're thinking, do I want to get into the XLK? You really want to take a look at Microsoft and look at their chart. Go look at their relative strength. Microsoft, a leader among software. That's awesome. Apple, of course, a leader among computer hardware. That is almost 40% of your ETF. You own Apple and Microsoft. So if you buy the XLK and then you go out and you buy Microsoft and Apple, that you are really putting a lot of eggs in one basket. Maybe that's what you want to do, but know what you own. That's a really important thing. And if Apple begins to show negative divergences, or Microsoft does the same, or maybe we get a breakdown on volume, those individual stocks, you can have technology continuing to move higher, but those two stocks are going to really hurt the XLK. So you need to be aware of that. So what I want to do is just bring up some other stock or some other ETFs and tell you the key components. XLI. XLI is probably as widely diversified as any of them. The biggest stock is Boeing at 8%. And then you've got Honeywell at 5.25% roughly. So the top two there are only 13% versus the XLK where you've got almost 40%, 38 plus. All right, XLY, let's pull up discretionary. Amazon, 22.3%. Home Depot, 10.3%. Combined, almost 24%, or excuse me, 34% between the two. Or almost 33%, I should say. But when I look at the XLY, it's just broken out. So I want to consider, maybe owning this one. And you look at Amazon, and Amazon just had the big volume move, breaking out above all this sideways consolidation. Now, it hasn't broken out above this level in July, but it is starting to show some nice relative strength on that move last week, in the volume last week. So looks like maybe the relative downtrend line has broken. What I would like to see is this relative strength line taken out there. If Amazon can do that versus its peers and continues to trade above its rising 20-day moving average, I think Amazon is something to consider. The other two, I just want to mention the last two aggressive sectors, financials, XLF. This is something important to note. 5 of the 6, Berkshire is the number one holding, 12.5%. The next 5 stocks, 12%, 8%, 6%, 5%, 2.5% are all banks. JP Morgan, Bank of America, Wells Fargo, Citigroup, USB. So those 5 are going to have a huge impact. So if you get into the XLF, you got Berkshire plus banks, which equals almost 50% of that ETF. Know what you own. And then the final one I wanted to do is the XLC. This is communication services and Facebook, 19%. Google, between their the GOOG, G-O-O-G, and G-O-O-G-L, different classes of shares, that's over 23%. So between the two, 42%, 43% in that range is Google and Facebook, which I actually like both of those charts right now heading into 2020. So communication services is one to consider. But again, know what you own. That's really important. All right, we are now going to move into our final segment, which is the 3 you must see. And again, as I mentioned at the top of the show, I want to take a look at this from a long-term perspective, because there are, we talk about the short term and, oh, this stock made a breakout above, the July high. Well, I'm going to be talking about stocks that have made big breakouts looking back through multi-year consolidation. Look at Tesla. I remember talking about Tesla one of these times in 2018, might have been last fourth quarter. We got up near 390, and I said I really wanted to see this breakout, and we didn't get it, and you can see what happened. It, stock went from 400 down to 175. Held these prior lows, though, and now taking back off again and breaking out this time. I think Tesla could have a really good 2020. Watch 390 to 400 to the downside, but Tesla made a big breakout, something to keep in mind. All right, let me see. Next up, let's look at Xilinx. Now, Xilinx, you might look at it, and as I looked at it earlier this year, I remember talking about this on one of the shows or maybe in a webinar, and I kept saying, Xilinx is just not good. Semiconductors been flying, and Xilinx has been moving lower. It just doesn't look good. Relative strength. Let me show you the 1-year relative chart. We'll come back to this chart. But here you can see Xilinx has just been moving down. Semis have been moving up. Look at the relative strength. If I looked at the daily chart, I would say, no chance. This stock, stay away. Well, when you look at the weekly chart, it does give you the idea that maybe this thing is getting ready to turn. So what I would do on Xilinx is I would really pay attention and watch this wedge. And it's kind of hard to, you could draw it from the highs, you could draw it from the candle bodies, maybe right in here. That might be the better place to do it. And then you've got these lows, squeezing piece of pie off of an uptrend. When you get this moving to the downside, this is what's referred to as a bullish wedge. And they normally break to the upside. So watch this. If it breaks back up above, especially that 50-week moving average, I think Xilinx could be something definitely to keep an eye on in 2020. And then the last one for similar, in a similar area, Qorvo, QRVO, also in the semis. Look at this sideways consolidation for 5 years. Just broke out on volume. This could, and we've seen this stock make big runs before. I know it's gone up a lot already. I think it could just be getting started. So keep an eye on Qorvo in 2020. All right, that is it. I do want to thank everybody for stopping by. Please keep in mind Saturday, Market Vision 2020. Go to earningsbeats.com. Check that out. We'd love to have you join us on Saturday. John Murphy and the gang will all be there. Everybody have a great day. Happy trading.